Hey everyone, Tyler here. I'm really excited about today because if you're looking to buy a home, FHA is a phenomenal option when it comes to low down payments as well as flexibility to be able to get a loan with low credit scores. So we're going to be going over all of those details in this video. So if you're a first-time home buyer or you're looking to buy your first home or maybe your second home, FHAs are a great option, and we're going to go over every detail in this video. And then at the end, I'm going to share with you a few resources you're definitely going to want to check out to be able to look at FHA loans specific to your area. So stay tuned for that. And without further ado, let's get started. Okay, so let's go ahead and start with an overview of FHA loans. And this overview is actually, you'll see on the timeline down below this video, where are the different sections that you can fast forward and go to each section that you may have more questions about or are interested in, so you can get the information that you're looking for. So right here, so as you can see, right at the top is a credit score between 500 and 579 with a 10% down payment. These are based on your FICO score. You also have a credit score of 580 or higher, allows you to put down 3.5% for a down payment. You're also going to have a mortgage insurance premium, and this is going to be required, and we'll go over the details of that here in a later slide. You're also going to have a debt to income ratio. This is going to be around 43%. As we get into this, there's going to be a front end and a back end, and there are some exceptions to this, and we'll explain how to calculate that. In addition to that, the home must be a primary residence for the borrower. And then the last bit that we'll cover is the borrower must have steady income and proof of employment. So let's go ahead and get started with the requirements, and let's start out with that low credit score of 500. You can get qualified for an FHA loan all the way down to 500. So with that comes a 10% down payment. If you want to be able to qualify, you're going to have to be able to put down a 10% down payment. Now, one thing I do want to note here, and it's the first bullet here, is that not all banks will accept these terms, especially since COVID happened. A lot of banks make the requirements 640 or above. But according to the FHA, the minimum requirement for a borrower to get qualified is going to be a 500. So just the same way as you would call different service providers for doing your plumbing to try to get the best rate, you may have to call different banks to find out if they are willing to go down all the way to a 500 credit score. And if they are, there are going to be some additional requirements that we're going to have to go there. But the question is for you, if your credit is that low, is why is it there? Because if it's there for a reason. As you can see here, it could be because of a bank or a bankruptcy. It could be because of a foreclosure. It could have been due to a short sale or a deed in lieu of a foreclosure. Those things may affect your ability to get qualified. You may have collections or missed payments or medical bills. These all could affect your ability to qualify, even though your credit may be within that 500 to 579, which technically you would qualify for. Some of these things could actually push you out of the ability to qualify. So let's take a deeper look here. According to the FHA, there's waiting periods for some of these things. If you have a deed in lieu of foreclosure, there's a waiting period of 3 years. For a foreclosure, 3 years. A short sale is 3 years. And then a bankruptcy with a Chapter 7 is 2 years after discharged. Okay, so furthermore, with this 10% down payment and this credit score between 5 and 579, there's additional underwriting factors. See, if you don't get an automatic approval, banks will have to review. I'm reading directly from the slide here. Review your entire file and your situation manually to determine if they would be willing to approve your application for a loan. And now the things that they're actually going to be considering, or the things that they're looking for, is going to be what they call compensating factors. These compensating factors are to help compensate for the low credit score. They're going to have to look at these additional items to determine if they're going to be able to give you that approval you're looking for. For example, they may look for more on-time rental payments. They may require additional reserves in addition to what you're going to be putting down in your closing costs. They may look for 1 to 3 months of reserves that you're going to be able to set aside and not use towards buying this house, so they know you have funds available. We have debt to loan, right? Your debt to income ratio. And in the case of your credit being below a 579, that debt to income limit is 31% on the front end, which I'll get into that further on in another slide, but it basically means the amount of a loan you can get, and the back end is the amount of total debt you can have based on your gross monthly income. And we'll give an example of that here in a minute. And then they may limit the amount of late payments that is on your credit history to be able to determine if you can qualify. Okay, so now let's take a look at your credit being above a 580. And now this is really where the biggest perk of having a low credit score and going FHA really comes into play, and that is with the 3.5% down payment. If your credit's above a 580, it's still well below what you can get with a conventional loan. You can only have to put down 3.5%. That's really, really big. On a $100,000 home, that's $3,500. $200,000, $7,000. That's it. That's incredible. So this is why, if you're interested in a low down payment option, FHA really could be the best option for you. In addition to the low down payment, there are some compensating factors. Now, I have on here that if you have your compensating factor between 31 and 43, there are no additional requirements, and you would be able to qualify and get your approval. If you have a 37 to 47, there may be more requirements that you'll have to get through, like those additional reserves or no late payments. Those things are going to come into play. The same for as you go down that list, even more and more requirements are going to be based on the higher debt to income ratios that you have. So let's answer that question, what this debt to income ratio really is. Now, their base is 43%. So let's do this based off of your gross monthly income of $10,000 to make it easy. So if you want to figure out what you would be able to do, if you want to do the math along with us, take your annual income and divide that by 12, and that would be your gross monthly income, and you would want to use that number in this scenario. So here we are looking at $10,000 a month. You're going to take that and multiply that by 43.43. That's going to give you $4,300. This is going to be the maximum amount of debt that you're going to be allowed to carry when you purchase a home. Now, the thing you need to remember is that this includes your future monthly payment. Now, remember, I'm just going to go back here. Remember that first number right there, 31? Well, that 31 represents the amount of a mortgage payment you could qualify for. So in this case, based on that $10,000 gross income, you could have a mortgage payment up to $3,100, as long as the rest of your debts, car payments, student loans, credit card payments, if you pay any child support, as long as those extra monthly bills don't exceed that $4,300. So you take $4,300 minus $3,100, that gives you about $1,200 of additional debt that you could carry. Hopefully that makes sense. That's what I mean by this front end. It represents what you could afford in a mortgage payment, and then that latter percentage is the maximum amount of debt, which includes that first number. that first percentage. So hopefully that makes sense. The max amount of debt is, just to make sure it's abundantly clear, that includes your future payment. Now, if you want to try to work this backwards, I did a video here just about how to buy a house, and it's the ultimate guide of buying a house, where I actually use Zillow, their mortgage calculator, and I show you how you can calculate backwards based on a purchase price and a monthly payment on what you could afford. And you can check that right here, and I'll link the timestamp. It's a longer video, so you can go directly to that spot and watch that portion of the video. The next requirement that we're going to have is FHA loan limits. Now, every year it seems that the loan limits are changing and they're increasing. And again, in 2022, we're seeing an increase in the loan basis for FHA loans. What this basically means is that they put a cap on the amount of a loan that FHA will allow you to get. In this case, the base loan limit is $420,680. Now, this is the loan limit. That means you would be able to purchase, based off of a 3.5% down payment, $435,937. Now, they base these limits based on low cost areas and high cost areas, and that would determine what number you would be using. And you can find a link down in the description where all you have to do is go there, put in your state and put in your county, hit search, and it will actually tell you exactly what your loan limit is in your area based on a single family, duplex, triplex, fourplex. You can get FHA loans on all of these type of income producing properties, as long as it is a primary residence, which we'll get into here in a second. The other thing that is on an FHA loan is your mortgage insurance premium. Similar to PMI, which is more popularly known in my opinion, MIP, or mortgage insurance premium, they have two ways they fund the ability for you to get this loan. They have a upfront premium, and then they have a monthly premium that stays on for the life of the loan. So the upfront premium is 1.75 times the loan amount. So if we use that example of $300,000, your actual upfront premium is going to be $5,250. Now, what they're going to do is not require you to pay that out of pocket, but they'll roll that into your loan. So if the loan again is $300,000, your total loan amount would be actually $305,250. Now, in addition to that upfront amount, they have a monthly amount, which is 0.85% of the purchase price, which comes out to a monthly payment amount that you would be paying every single month. Now, that amount is not going to be falling off the loan anytime soon. And in fact, it stays on for the life of the loan unless you put over 10% for your down payment. And if you do put over 10% for your down payment, it will fall off after 11 years. Now, as I said in a previous slide, the home must be the borrower's primary residence, and you actually have to move in within the first 60 to 90 days, not to be exact in that case, but you are able to turn these properties into future rental properties. Now, you can actually purchase a duplex or a triplex or a fourplex as long as you're moving into the property. And quite frankly, it is a phenomenal way to get into investing in real estate. It's actually what me and my wife did. We actually purchased a triplex. We moved into one side where our family lived in it, and on the other two units, we had tenants that paid for our mortgage. Actually, my payment I personally made was an additional $150. So it is a phenomenal way to start investing in real estate, but it has to be a primary residence. You are able to move out after you move in at a certain, typically it's 1 year. You can move out and you could actually rent it out and then go back and get another FHA to buy another property with a maximum, I believe, of 10 individual properties using an FHA or conventional loan. And the last requirement that we're going to be going over is your ability to have steady income and steady employment. Now, this is very unique to FHA because it doesn't require you to stay at one job, but they want to see steady income, whether it's 1, 2, 3, 4 jobs over the course of a 2-year period. Now, the longer you are at a current job, the easier it is going to be for that loan officer to actually use that income as far as your ability to purchase, but they want to see steady income. Now, this is where the banks will ask for additional information, and you're going to need to be ready to be able to provide that additional documentation to prove your steady employment. They want to see that you have the ability to pay. And if you do gig work or anything like that, it makes it very, very difficult to be able to get a loan because of the inconsistencies of income. And there you have it, guys. Everything that you need to know in regards to getting an FHA loan in 2022. All the links are in the description for anything that I referenced before. Guys, if you want to see additional videos that you might like in regards to this stuff, you can check out these videos right here. Consider subscribing over here. I greatly appreciate it. Consider giving me a thumbs up if you like content like this. I thank you for your support. I love you all, and I look forward to seeing you guys in the next video.